we are now going to discuss about the nature of stock prices, how the stock prices behave. You might think that okay, if this, because the stock prices can do zigzagging, it can be modeled by Brownian motion, but important thing to remember is that Brownian motion can take negative values while stock price do not. So, they model what is called the geometric Brownian motion. And let us now write down a geometric, what is the form of a geometric Brownian motion, which we have already written down in the previous part of this series of lectures in part 1. So, stock prices are assumed to follow geometric Brownian motion. Of course, geometric Brownian motion is built out of Brownian motion, and basically in this sort of situation you take an exponential, and exponentiation will actually give you the non-negativeness. So, what you would have is your components would, as before, your probability space, your trading time of the option 0 to t, 0 is the starting time, t is the expiration time, just from a very general point of view, just a time interval, Wt is a Brownian motion, and Ft is a filtration obviously f of capital T is f, actually the sigma algebra is a filtration associated with Wt. So, in the sequence also we are making this, I am writing it in such that you know that these are actually stochastic process defined over a given time interval. Now, a very general form of a geometric Brownian motion is defined in terms of what is called a stochastic differential equation, which we had already discussed in the last part, which is given in this form. Of course, these are shorthand for a stochastic differential, an integral equation rather than an e to integral. Alpha t is called in this case a stochastic, I am writing stock for short, stochastic mean rate of return on the stock under the market probability is a mean rate of return, and here is a stochastic volatility. So, this measures how much zigzagging or how much variation one has in the price. It tells you that over a certain given period of time how much we can expect the stock to give us back. In case of the Black-Scholes model, where alpha t is assumed to be constant and sigma is assumed to be constant, largely such estimations of the constant, estimation of the constant is done based on historical data, and for this particular equation you do have a solution. Okay. This can be written in the integral form as S of t is S of 0 into exponential, means e to the power, basically not writing e to the power this way, I am just writing is 0 to T sigma s dws, right, minus 0 to T alpha s minus half sigma square s. This term is, you might just forget this term pretty often, ds. So, this is the solution essentially of this stochastic differential equation, or SDE. Now, once this is known, we shall write down what is called the discounting factor. The discount factor, just like we are a discount factor 1 by 1 plus r, here to be more precise, we will assume an interest rate RT, which is itself a stochastic process. So, interest rate stochastic, which I am again writing for short, stochastic process, which is adapted to this filtration Ft that we had stated earlier. This is also t equal to 0 to t. So, RT varies very less possibly when you are looking at a very small time interval, or else it can vary considerably. So, RT is the stochastic process in the money market. So, money market here is exactly not a bond. In bond, if interest rate can change abruptly, very sharply in a very short time, but this is just essentially a bank. You can think of it as a bank. So, a discount process, so the discounting here is also a stochastic process. The discount process so e to the power minus RT type things, but a discount process d of t. So, at any time t, the discounting process is given by, instead of just writing RT, because you now have the process, you integrate. So, this is the definition of your discount process, or the discounting, or whatever you want to call the discounting process or discount process. Okay. Now, how can we write down this in terms of a stochastic differential equation? That is exactly what we will learn now. So, how do we write down this thing in terms of a stochastic differential equation? And here again we will use Ito's calculus. So, trick is the same, it is e to the power minus something. When you have processes e to the power something, always take your f that you will use in the Ito's formula as e to the power minus x. So, f dash x is minus e to the power minus x, and f double dash x is equal to e to the power minus x. Okay. That is f dash x in this case is minus of f x, if you observe. Now, if you look at, if I write this as my IT, this process as IT, Then from the fundamental theorem of calculus, assuming that they have nice properties, it will imply that I dash t or di t dt, I dash t, this is not a stochastic integral, this is ordinary integral, please remember it is ordinary integral. So, I am applying the fundamental theorem of calculus. For that, if you have a stochastic integral, I cannot. So, this is nothing but RT, right, and hence this implies that d of it, the differential, is nothing but RT dt. Now, what if I write d of dt? So, if I want to calculate the differential of the stock process, this process, it is actually d of f I t. Now, I will ask you to ponder and write what is it into it, dit into dit. So, dit into dit, the quadratic variation would be obviously equal to 0, because it will be r square t into dt dt, dt dt is an ordinary function, its quadratic variation is 0. So, then again by applying Ito's formula, we come to the following conclusion. So, this is f dash it dt plus half f double dash it dwt, sorry, dit, not dwt. Actually, this is not needed. When dt is a stochastic process, while this is just a normal integral. So, f dash it, if you put it here, is minus of fx. So, minus f of it minus f of it dt plus f double dash it is again e to the power minus it. So, which will be same as f of it. So, here it is again f of it dit dit, right. So, dit dit is 0. So, this gives you, so what is f of it? F of it is nothing but dt now there is some mistake I am committing somewhere. Also, this is not dt, I am making a mistake, it should be dit, some mistake has been committed in the Ito's formula. So, this is by Ito's formula. So, then what happens is that what is d of it? It is RT dt. So, it is minus RT dt. So, minus dt to RT into dt. So, d of dt is equal to minus dt into RT into dt. Now, consider now we look at the discounted stock price. So, what is the discounted stock price? dt into st. We would like to see whether under the risk neutral measure the discounted stock price is a martingale or not, just like we had seen in the case for the discrete scenario. So, in the discrete time scenario, whatever you have seen, whether they work for the continuous time scenario. So, now I will write down the discounted stock price. I will not do the complete calculation, I will ask you to check the calculation, which is a good exercise, but still I will write down the discounted stock price. The final answer is dt into st, that is of course S0 into exponential. This term inside the exponential needs to be calculated and checked. The first term is obviously plus 0 t alpha s. Now, you will have an additional term due to dt has this RT, exponential RT in the definition. So, you will have this term also, because this will get added. So, there are two exponential terms, the exponent thing here in the exponential gets added to the thing here in the exponential. The constant term really does not matter, it goes out. So, it is an obvious thing. So, I am not going to explain to you how it comes. This is just a very, very obvious thing, multiplying exponentials, that is all, you add the power. Now, I want to see what is the differential. So, what we do, you go by the Ito's product rule. By the Ito's product rule, if you go by, you will have dt into dst. You know what is dst, right, plus st into d dt, which you already now know. You have calculated d dt, you know what is dst, plus dst into d dt, that is Ito's product rule. It is called, this is called the Ito's product rule. It is just like the product of the derivatives, but additional term which comes out for because of the quadratic variation. So, now once you have this, a complete calculation will show that you have the following. So, please check this calculation, not hard, but just too many of algebraic manipulations which we are not doing at this stage. Now, construct the function, consider the function theta t is alpha t minus RT by sigma t. So, if you do this, and here you can replace this by sigma t theta t. So, then it implies that the differential of dTst is equal to sigma t dt st into theta t plus dwt, sorry, theta t dt plus dwt. So, what is this? This is, if I now consider I consider w tilde bar as theta t, w t is theta t, 0 to t theta theta s ds plus w t. If I consider this and then I consider theta, I construct the process z t in the as in the Girzanov's theorem in the last class, putting that theta. Then in the same way, using z as z of capital T, we can construct a risk neutral measure. We can now construct not a risk neutral measure, we go out or measure p tilde, which we will call the risk neutral measure. So, from here we can create a p tilde such that under p tilde w tilde t is a Brownian motion. Isn't that amazing? So, you have now constructed a new thing. So, what you have got? Sigma t dt st. Now, if I, what is dt st? So, if you look at, so what is dt st? dt st is nothing, d0 into s0, d0 is 1, s0 is s0, is s0 plus 0 to t sigma s ds, that's not okay, sigma u du su d w tilde u. So, this is an Ito integral under the, in terms of the w tilde, the Brownian motion, which is a Brownian motion under the new probability measure p tilde, which we called the risk neutral measure. And so, what we have proved here, because every Ito integral is a martingale, we have proved here that DTST, the discounted stock price, is a martingale under P star. Actually, P and P is not P star, P tilde. P and P tilde, as I told you yesterday, are equivalent measures. That is, they agree on sets of measure 0. If a set is null set in terms of P, it is null set in terms of P tilde and vice versa. Martingale under P tilde. This thing would be of big help to us, we will soon see. Actually, in writing the risk neutral pricing, this will be of fundamental help. If you remember what we did in the last week's class, where we had done the discrete time thing, this is exactly what we need to look into. So, okay. So, once this is done, then it is important that we should know under the risk neutral measure, how does the stock, how does the standard stock price would look like, and this is a very important thing. So, we will now write down under the risk neutral measure how the stock price looks like. Now, if I want to write down the stock price, then what should I do? So, I will do it in detail. Now, this term theta t, which is alpha t minus r t by sigma t, this is always a non-negative function, because in general alpha t is the rate of return under the market probability, which is obviously bigger than the one under for the money market, the return for the money market. This is usually strictly bigger than 0. Okay. Now, dst, so we have already seen d of st is equal to alpha t st dt plus sigma t st dw t. So, let us see from here, let me write down what is alpha t. So, it is theta t sigma t plus r t this into s t dt plus sigma t s t dw t. So, this quantity, it is also called the price of risk, that if you have taken the risk of investing in the stock market, this is the price of risk, right. Suppose alpha t goes below R t, then you are losing. If alpha t is bigger than R t, you are winning, having is better. So, this is sometimes called the, this quantity is called the price of risk. So, sigma t s t dw t. So, this is what we have got. Now, what I do, now I take this spot sigma t s t and add up with this spot and keep this spot separate. So, I will have R t s t dt plus sigma t s t theta t dt plus dw t. So, what is this? This is nothing but dw tilde t. So, you have R t s t dt plus sigma t s t dw t. So, this is now, so this equation, so if I write it down in more detail, so dst, so this is the stochastic differential equation governing the stock price movement. It is a geometric Brownian motion under the risk neutral probability of the, or this Brownian motion, where the rate of return of the stock is same as the rate of return of the money market. So, under the risk neutral measure P tilde, the rate of return of the stock is rate of return in the money market, of course. So, that is why this P tilde, because here you are neutral to the risk, because even if you put in stocks or whether you give it in the money, they have the same rate of return. That is why P tilde is often called the risk neutral pricing. It is neutral to risk. It is called the risk neutral probability. So, here now we have a fairly good idea how to handle things. So, we will stop our first lecture here and go to the second lecture of actually computing the Black-Scholes price, computing the price of a European call option, which we will again start in detail. Thank you very much for observing, taking a careful look at this talk, but we very carefully calculate all the calculations I have done in detail. All the things that I have written down should be checked in detail. Thank you very much.